Chamath Palihapitiya is a venture capitalist who has made headlines lately for his zealous endorsement of SPACs, which his firm has deemed the IPO 2.0. He views SPACs as an innovative tool for taking companies public. He says that SPACs will change the way capital markets operate and provide young companies flexibility in going public and stability for long-term growth. Chamath's name has been attached to no less than 12 SPACs. He has reserved the stock tickers IPOA to IPOZ. He plans on taking them all public. Everyone has heard of IPOs, or initial public offerings. Traditionally, if you wanted to take a company public, you would file for an IPO with the SEC and go through months of paperwork, rounds of due diligence, and finally go public after a thorough review by regulatory agencies and presentations to potential institutional investors, all of whom are trying to shake any skeletons out of the closet. Chamath says this process is too slow and too old-fashioned. Rather than going through the rigorous process of an IPO, a private company can be made public by merging with a SPAC. In case you don't know how SPACs work, here's a quick explanation. SPAC stands for Special Purpose Acquisition Company. You might also hear them referred to as blank check companies. A SPAC is a shell company made by a sponsor, such as Chamath. Chamath presents his SPAC to investors who give him money to take that shell company public. Once he has enough investors, Chamath's team works and finds a suitable private company to take public. Once the investors agree to take that company public, the private company merges with the SPAC, and voila, it's trading on the stock market, the same as if it had gone through an IPO or direct listing. The SPAC process is faster and less transparent than an IPO or a direct listing, and Chamath says that it offers retail investors, i.e. the regular Joes, a better chance to capture the early gains that so often go to institutional investors in IPOs. An interesting note is that the private company that goes public doesn't even really need to be one that fits the original stated vision of the SPAC or is even close to that vision. Earlier this year, a SPAC by the name of Stable Road Acquisition Corp. initially presented itself to investors as a vehicle to take a cannabis company public, and eventually it merged with Momentus, a company with a mission to pioneer cargo hauling through space. In a situation like this, the SPAC's investors get the opportunity to take their money out of the SPAC with interest, or to go ahead with the merger with their investment on the line. In the last few months, the stock market has been zooming and the SPAC boom has been booming. Everyone wants in on the SPAC game, from Shaquille O'Neal and Alex Rodriguez to David Geffen and Reid Hoffman. As a matter of fact, right now in 2021, there are almost 450 SPACs publicly listed, all prowling for the perfect private company to take public. These 449 SPACs have a total of $143 billion in trust, an average of $318 million per SPAC. Like I said, SPACs are booming. So this SPAC boom, is it a fugazi? What do intelligent investors like Chamath like so much about SPACs? And why are hedge fund managers saying the SPAC bubble is about to burst? Let's find out. Chamath is a very vocal advocate for SPACs. He notes that in the year 2000 there were about 9,000 public companies, and that number is now around 4,000. He says that in order to grow and strengthen America's capital markets, our economy needs as many viable companies to go public as possible. Chamath specifically wants to focus on startups with these SPACs because of their ability to innovate and disrupt existing markets. He notes that approximately 2/3 of the S&P 500 does not have R&D budgets, which quantifiably points to a lack of innovation and a lack of foresight. He says that this points out the market's focus on current cash flow rather than rewarding companies that have a focus on the future. His IPO 2.0 platform focuses on young, high-growth companies that have a time horizon of 5 to 10 years for realizing their vision. And I know I'm a cynic, I know I'm a skeptic, but in business we should always keep in mind the Latin phrase cui bono, which means who benefits. In this case, what's in it for Chamath? Well, the answer is lots and lots of money. SPAC management teams like Chamath and his partners receive discounted shares of the private company. So if the share price grows after going public, as often does, the SPAC management team captures a tremendous amount of that capital growth. This is one of the criticisms of SPACs because the SPAC management often gets a return on their investment, where investors may or may not. In addition to this payday, typically the sponsors of the SPAC will get a finder's fee for locating the company to be acquired. And although Chamath has stated that he doesn't accept any fees, other SPACs would certainly recognize and capitalize on this chance for more money. Chamath has said that SPACs are a way to take companies public and democratize the growth that frequently happens immediately after an IPO. He says that in a typical IPO, retail investors get railroaded and left holding the bags, while institutional investors get the real gains. This is because in an IPO, large institutional investors such as mutual funds, pensions, and investment banks get preferential pricing for their shares. In a SPAC, the sponsors and investors, a much smaller group of people in theory, get that preferential treatment, and the idea is that there's less of a chance that retail investors can be left out of the buying opportunity and left holding the bags. But honestly, that remains to be seen. Very similar things can happen and did happen with the example of CCIV. Churchill Capital Corp. 4 was a SPAC that popped up to $58 on the news that it might merge with Lucid Motors, an electric car company. Retail speculators jumped into the stock hoping to capitalize on an opportunity, but they were left holding the bags when it was announced that preferential shares were sold at $15. The stock has almost halved since its highest point. Granted, in this example, retail investors were able to get in on the trade before Lucid was public, so it was theoretically democratized, but in this case, they were democratizing losses. Holding the bags. So in the sense of risk to the retail investor, SPACs are about the same compared to an IPO, or maybe even a little more risky due to the fact that there is less transparency in their onboarding process to the market. Earlier I mentioned the Stable Road Acquisition Corp that acquired Momentus. That SPAC had a scare earlier this year when, without notice, their CEO announced that he was leaving the company immediately. What happened was now that Momentus was going to be a public company, their CEO's status as a Russian national posed certain risks for national security. There were some security concerns that he would have access to classified space technology. This is almost certainly a topic that would have been scrutinized during the traditional IPO process, whereas the SPAC got them trading really quickly and with little regard to any irregularities. So SPACs have their pros and cons like any other IPO method. Why would a SPAC need someone like Chamath? Well, first off, Chamath is a great salesman. He's an institutional investor with a proven track record. Not only was he an early executive at a little company called Facebook, but he's taken Virgin Galactic, Open Door, Clover Health, and soon SoFi public. He has a glowing resume and his reputation well precedes him. And this is why he's a perfect figurehead to lead the SPAC movement. His reputation lends legitimacy to the investors of the SPAC, where it would be difficult to get most people to invest in the unknown. If you can have someone like Chamath be the salesperson for a SPAC, he can point to his own success and say, hey, do you see how well I've done in the past? He can go on CNBC and pitch a hypothetical investment in a company that's supposedly been done a disservice by the IPO market and say that the real way to take them public is with a SPAC. A figurehead like Chamath lends not only credibility to a SPAC, but obviously his deep pockets help too. Chamath puts at least $100 million into each SPAC, saying that he feels it's important to have meaningful skin in the game, where it provides more motivation for better diligence. But having a figurehead like Chamath market a SPAC on TV or on his social media is a double-edged sword. Because the private company is merging with a SPAC and not going through the rigorous process of an IPO, they're allowed to be marketed more freely to retail investors. Founders and insiders can disclose much more to the public, most likely in an effort to advertise the merger and increase the stock price. Combine this with the opacity of information during a SPAC, and you can have moments like the Momentus drop happening over and over and over again. And this is one of the reasons that hedge fund managers like Nate Kopakar, manager at Orso Partners, say that the SPAC boom is going to bust. They shout that the opacity of SPACs will lead to abuse, which would result in pump and dumps and other dangerous manipulation. Kopakar said to Institutional Investor that this mad rush to find private companies for SPACs has resulted in companies becoming wildly overpriced and have resulted in retail holders left holding the bag. In addition to this, the hype surrounding SPACs has not only attracted bulls but bears, such as the short-selling firm Hindenburg Research, who recently called CCIV short, and now they're going after Clover Health, one of Chamath's SPACs. So bears and hedge funds aren't sure about SPACs, because hedge funds are always looking to protect the integrity of the markets, right? Remember what I said before, guys? Cui bono? In addition to the negative sentiment about SPACs from some parties, other agencies are trying to level the playing field. The New York Stock Exchange is trying to undermine the popularity of SPACs by introducing a new rule that allows companies to raise capital through the process of a direct listing. Direct listings have only allowed companies to sell existing shares of stock, not to create new equity to sell on the market. But this rule would make direct listings a more direct competitor to SPACs. But still, Chamath has a rebuttal. Now that Coinbase has opted to go public via a direct listing, he tweeted that the Coinbase direct listing will either confirm direct listings as a reasonable on-ramp for companies or kill them altogether by once again making retail the true bag holders. Everyone says they're looking out for us, I just can't tell who actually is. But while Chamath keeps banging the SPAC drum, we're gonna have to wait and see how the rest plays out. If you enjoyed this video, then please click the like button and share it with a friend. Subscribe to my channel for more videos about business, money, and influence, and be sure to follow me on Twitter and Instagram at Ross_Campoli. What do you think of SPACs? What about Chamath? Let me know in the comments down below. As always, thank you so much for watching, and I will see you in the next one.